Good morning, everyone. If you would take your seat, please, we will begin. There's plenty of seats. Those of you in the back of the room, if you would make your way forward, have a seat. Drew, Eddie, if you all will help usher people on to the seats there, we will get started. We appreciate that. Again, good morning, everyone. My name's Mark Haney. I'm president of Kentucky Farm Bureau, and I want to welcome you to our 95th annual meeting here. But it's always so appreciative of us when we're able to combine this session, really leading off for our annual meeting. It's always a pleasure to be able to have everyone here and be able to see the presentation on the Agriculture Review and Outlook for the next year of 2015. Again, I just want to say how much we appreciate you being here and participating and listening, and we appreciate the university being here again and having all these folks here to make presentations. But without further ado, I'm going to turn it over to the Dean of the College of Agriculture, Food and Environment, Dean Nancy Cox. Please give her a round of applause, please.
Thanks, Mark. I've been in this job of Dean for a little bit less than a year, and I have finally found the best job that a Dean has at this college, and that is to introduce the team that's going to present the information on the outlook for you all. We have a team of experts who are valued faculty members and staff in the college, and who are nationally and internationally recognized for their expertise. And the information they're going to provide is important not only to Kentucky farm families, but truly to the economy of Kentucky. Lee Maynard, the Department Chair of Agricultural Economics, is going to introduce the team, and thank you all so much for being here.
Well, good morning, everyone. Thank you all for being here. I'm Lee Maynard, Chair of the Agricultural Economics Department at UK's College of Agriculture, Food and Environment. We're very happy to be on the program, and thanks to Mark Haney and all of Kentucky Farm Bureau. We have a panel of experts here today to share with you a summary of 2014 ag and forestry markets, and then they'll look ahead at expectations for 2015. We'll start with Will Snell's comments on the U.S. and Kentucky ag economy. Next up will be Kenny Burdine, our livestock and meat specialist. Then Todd Davis for the grains outlook. Back to Will Snell for the tobacco outlook, followed by Tim Woods on horticultural markets. Jerry Pierce will talk about farm incomes and family living expenses, and Jeff Stringer will summarize forest products markets for you. And if there's time, I'll give an advanced screening of an upcoming report by Allison Davis about the importance of agriculture to the Kentucky economy. A summary of today's comments is in this publication that's at the back of the room and will be on our website very shortly. And big thanks to Kevin Heidemann for putting that publication together. He's in the back of the room, and Heather LeBoiteau for putting together today's presentations. When we're finished presenting, we'll take questions from members of the press first, and when they've satisfied their curiosity, we'll open it up for further questions. So without further ado, let's start with Will Snell on the U.S. and Kentucky ag economy. Thank you.
Thank you, Dr. Maynard, and welcome everybody again to this session. That's something I always look forward to every year, and I think you're probably not too surprised that we've got a lot to talk about. My role, as Dr. Maynard pointed out, is to kind of give the big picture, kind of where we are, the state and national ag economy, and then my colleagues will give a little bit about the commodity outlook. And I'm sure most of you are not surprised that the commodity outlook is very, very mixed this year. Those of you all with smiles on your face, I take it you're probably a livestock producer. And a few of those that have got frowns on your faces, well, you're concerned what's happening on the crop side and the grain outlook. But I have basically two takeaway points that I want you to focus on. And one is that our collective outlook for 2014 for Kentucky For 2014, we feel pretty good from a cash perspective. It's 2015 where we've got a lot of concerns, and again, especially on the crop side. And the other takeaway is that you're going to see in some of these slides for Kentucky relative to the national outlook is that we're going to benefit a lot in this state from the diversity of agriculture. The mix between crop and livestock is really going to support the Kentucky ag economy more so and insulate us from some of the concerns at the national level. So I'll start a little bit at the national level. Let's talk a little bit about prices. We all know we're involved in agriculture. Agriculture is traditionally known for volatility in prices. But what has been amazing is the price volatility we've experienced the past couple of years. Basically, crop prices are down over 30% the past couple of years, with certainly corn down about 50%. And if you look on the other end of the spectrum, livestock prices are up about 30%. And you know, those of you all in the cattle business and know about those lightweight calves have basically almost doubled in the past couple of years. So again, a lot of volatility on the price side. So we take these prices, we multiply that by the quantities, and that gives us a cash receipt number at the national level. So again, we've got this large decline in crop prices, but we've had big crops. So that somewhat supports a little bit of the downfall on the crop value. And on the livestock side, escalating prices, but yet very tight supplies, which again doesn't necessarily allow the livestock value to increase as much. But again, when you combine those two together, the national forecast right now for cash receipts for the United States is only down about 1% for 2014. We take these cash receipts, then we subtract off the expenses. Expenses, fertilizer, chemicals, but also those animals purchased, labor, crop rents, and collectively those are up considerably. And then you add back in government payments, and government payments are off this past year. So when you put all that together, the national number that USDA came out with just last week is for a 21% reduction in net farm income for 2014. So again, a pretty large decline in net farm income for 2014 at the national level, but again, still fairly high on historical standards. Now, one thing that has enabled that net farm income not to fall as much has been the growth in the export market. And primarily growth in livestock exports have been very strong. We're actually set this a record level in terms of U.S. agricultural exports in fiscal year 2014. But on the horizon, we've got these excess crop supplies. We've got a little bit of an increase in the value of the dollar. Some of our major export markets out there are having sluggish economic growth. And all this transpires into probably a reduction off that export high in 2015. The other positive news, at least currently, is the balance sheet for U.S. agriculture. The asset growth we've had over the past couple of decades, with land values more than tripling since 2000, coupled with relatively low interest rates, puts agriculture, at least going into 2015, on pretty strong financial setting right now. But again, as we look ahead, we've got a situation where these crop returns we know are going to go negative. We've got a situation we've got interest rates are going to go up. And as a result, there's no doubt that we're going to begin to put some downward pressure on land values and potentially crop rents as we move forward. What about Kentucky? Those of you that attended this conference in years before have always said Kentucky, Mr. Haney, is somewhat unique. We're a little bit different than the rest of U.S. agriculture out there, certainly with our diversity. And one thing that we do as a group every year is come before you and make our forecast on cash receipts as well as net farm income. The blue bars there represent our estimates every year at this meeting on cash receipts. And the red line there represents the actual USDA number that comes out about 8 to 10 months later. So obviously I wouldn't show you this slide if those two had a big differential, but I'm very proud of my colleagues as we've done pretty well, Dean, over the years in coming up with our estimate. And last year at this time, we forecast a major event that we talked about, a $6 billion ag cash receipt number for Kentucky agriculture for 2013. And I was very curious about this number when it was going to come out. It was delayed a couple of months. And Greg, finally the number came out last week, and it was somewhat disappointing that we didn't exactly hit that $6 billion level. But when I began to look into the numbers, the differential was due to the fact that USDA has now revised a little bit of how they measure the equine industry, and perhaps we can get into some details later on this. But it's about a $300 or $400 million difference. So, Dean, if you kind of take that into account, then your team up here didn't necessarily do too bad in that forecast. But again, that $5.7 billion level becomes our baseline as we move forward in making our forecast for 2014. Now, the last slide that I presented last year here at the press conference as we look forward to 2014 was this one here. Probably no surprises. We were forecasting last year at this time that grain was going to be a concern. Obviously, the increase in global supplies of corn and soybeans we felt was going to be a drag on the marketplace for 2014. No surprise that we're very upbeat about livestock with lower feed costs, with tight supplies, with the export market. We were very optimistic about the outlook for livestock at this meeting last year for the coming year. And I think as I look back at what we said, obviously we hit the trends right, but I don't think we were as volatile. Our expectations on the price differential was as great as we anticipated this time last year. And the other things, we were pretty upbeat about the rest of agriculture in Kentucky as we looked in 2014. So that's where we were last year here at the Farm Bureau press conference. I polled my colleagues just a few weeks ago and again asked what their outlook for cash receipts for the state for 2014 would be. And we came back this year estimating that cash receipts would be up 5%. Probably no surprise when my colleagues get up here, we'll talk about the strong livestock sector. Kenny will follow up and talk about that. A lot of that growth was due to the livestock sector. But also our estimates came back with stability in tobacco, stability in equine, and stability in grains. Now, a couple of questions that I'm sure so many of you all have. One is, you remember the national number was down 1%, and Kentucky is up 5%. Well, Bill, again, gets back to us being more livestock dependent than the rest of the United States as a whole. So that's one of the things to take in consideration. The other thing is the stability in grain cash receipts. You're sitting there $3.50 corn right now and thinking about how can that be? Well, keep in mind this number is on a calendar year basis. And when did most of you all sell a lot of that high yielding corn and soybean crop from 2013? You sold it earlier this year at much higher prices. So again, that's going to have some implication in our estimate for 2014. We're basically coming back next year. Those crop receipts are going to be off considerably with the grain outlook that Todd will give here in a few minutes. The livestock momentum we think will continue as we move into 2015. If you look at the distribution, poultry on record but still remains our number one cash receipt, followed by cattle, soybeans, and corn. What about net cash income? This is looking at those cash receipts, taking off expenses and adding back government payments. And you see that steady growth that we've had over the past couple of years, or the past 4 or 5 years. We feel, again, on a calendar year basis, net cash income is going to be still relatively strong. Get higher cash receipts, plus the fact that we got those tobacco buyout payments. So again, 2014, relatively strong, but 2015, when those lower cash receipts come in, we don't have those buyout payments, that's going to be our concern. We feel like that net cash income figure for 2015 may go back to the levels that we had in 2009, 2010. So a big adjustment in 2015. My last slide as we wrap up here, some issues that my colleagues will focus on. Obviously, grain is a big concern, remains a concern. You know, will these low prices respond? Get a demand response? You know, how are acres going to adjust and land rents? What about the Farm Bill? Is it going to be a safety net out there? What about the renewable fuel standard? Will that be adjusted? Livestock, Kenny will be up in a moment and talk about how that's very, very positive. And for the rest of our outlook, with the exception of tobacco, we feel that most of our ag enterprises will have a very favorable 2015. So we're going to start you off this morning on the optimistic side, and Kenny will get up here and give his viewpoints on the livestock outlook for 2015.
Well, thanks a lot, Will, and thanks for having me yet again. Nice to bring some positive news today. Not always been the case, but a lot of good news today. When I first started doing this 6, 7 years ago, that wasn't always the case. I'm not saying I'm responsible for it. I'm just simply making a point that things are a lot better than they were when I started. So draw your own conclusions from that. Start with poultry. Big picture. Several years ago when I talked to you, I made the statement that we did something that was very rare. We actually pulled back poultry production for a year or two. That was very unusual. I typically see growth every year. We did that in response to lower broiler prices. As I talk to you today, we're kind of back on our typical trend of broiler production up about 3% from 2013. What's interesting about this year, though, and this is going to be the case for a lot of the meats, despite the fact that production's up, blue line there's 2014, notice broiler prices have been up since about March or so of this year. Okay, so higher production levels and higher prices typically signal strong demand. That's the case across most of these meats. Exports account for roughly 1 in 5 pounds that we produce on the poultry sector. As we look ahead to 2015, my guess is this production increase continues, probably another 3% or so. At the same time, we've certainly benefited this year by cheaper feed prices, another theme that's going to be across these livestock sectors. So this is an integrated, contract-driven industry. If we think about the future, it's important to note those integrators have benefited from higher prices and cheaper feeds, so the health is fairly strong. In terms of the hog market, very similar story I could tell. One difference, though, is hog production actually was down a bit last year, okay, and certainly down for most of this year. And that was for a couple reasons. Not so much the price. If you look at Eastern Corn Belt hog prices, blue line 2014 again, we were actually fairly strong this year, okay? Black line's 2013. Historically, that's a pretty strong hog price level, okay? The challenge, obviously, for 2012 and for about 2/3 of 2013 was very high feed prices, squeezed margins. For that reason, production was down a fair amount early in 2014. That's likely to change. Looking ahead this year, profitability that we've seen, looking to next year, we'll see pork production increase. My guess is these hog prices come down a decent amount in 2015. I'm guessing the biggest drop is in the first half of the year next year. Equine market for a sec. We talk a little bit about this all the time, but we talked a whole lot about equine recovery from recession. Okay, saw some improvement in 2012. If you remember last year when I talked to you in this very room, I said I think 2013 is going to be the year that we remember we turned the corner on this market, and I still believe that to be the case. One way to track this, here's Keeneland thoroughbred sales. Okay, notice the big jump from 2012 to 13. Oops, sorry. Okay, notice though we sustained that level for 2014. Okay, that to me is encouraging that we sustained those much higher levels. Market seems very much back on track. As we think about the future, I make a couple quick comments. Okay, number one, the fact that these markets are stronger, sales are stronger, should be supportive of both sales and stud fees in the future, this year, next year, and the one after. That's, I think, a positive factor. The other point I want to make, we talk a lot about thoroughbred sales. It's very important, major driver of receipts. Something that doesn't get talked about a whole lot, though, is there's a cost side of horse operations, too. Okay, a lot of horse operations are very affected by this. If you look at Kentucky's alfalfa hay production, so hay's kind of a crop that's sometimes under the radar screen. We have about 2 million acres of grass-type hays and about 250,000 acres in the state of alfalfa and alfalfa mix hays. If you look at alfalfa hay production over the last 15, 20 years, you see a pretty strong downtrend. Some of this is weather and yield driven. A lot of it, though, is a loss of acres. Okay, I can take you back and show you years when we had over 400,000 acres in alfalfa and alfalfa mix hay production. And a lot of this, I think, more recently was conversion of a lot of this alfalfa ground to row crop production. And this is a challenge, as it has had an effect on hay prices. The other thing that it's done, remember this, hay is an expensive product to transport. Okay, so in terms of cost, if we think about hay that has to get sourced from other places, this drives the cost up. So this is kind of something to keep in mind as well. The dairy market's had certainly an outstanding year, one of the best probably on record. A very big change from 2 years ago. Two major things I can say, okay? The two best things I can say. One, milk price is up. Two, feed prices are down, okay? Winning combination if you're in the dairy business. Looking at U.S. all milk price, for example, we're up $3 or $4 from where we were in 2013, okay? U.S. all milk is going to average somewhere in the $24.50 range, I think, for this year. A couple components I've kind of been watching. In particular, the strength this year has been driven by, I think, butter and non-fat dry. Both of those have softened some in the second half of this year. It's something I've been watching. Secondly, you can go back and really go back to about the second half, maybe third quarter of 2013, okay? And that's when we really saw those feed costs come down. So what you're looking at now is just a typical 16% dairy ration, just a baseline idea, okay, of feed cost on a dairy operation. The thing I think to note, though, is that this has coincided very nicely with an increase in milk prices. So that this has been an exceptional year in the dairy sector. Interestingly enough, this exceptional year in dairy coincided with the first year that we had the new program established in the Farm Bill, the Dairy Margin Protection Program. Okay, so tomorrow is the deadline for signups for this program for 2015 and the rest of 2014 calendar year. We're doing this at the same time that margins are as high as they've probably ever been, or certainly in the past. So producers are making a decision between this program right now, okay, and the livestock gross margin for dairy program has been available since I think about 2008. Looking ahead to 2015, a couple things to think about. One, production will most likely increase in response to these higher margins. Okay. Two, exports may be affected by better weather in Oceania. And three, the fact that we're seeing some component values come down sends a signal to me that I think U.S. all milk price probably drops something like $4 to $5 or so as we think about 2014 versus 15. So still a decent year, but not near what we saw this year. Small ruminants quickly. Very strong markets here, okay? National numbers bounce around a lot. You can look at national sheep and goat numbers. They change. They're up, they're down. If you look at the last several years in Kentucky, we've seen continued growth in small ruminant numbers in the state. And I think that's a testament to the strength of these markets. Those prices are strong. I think they'll stay strong. I think these markets are fairly healthy. Cattle, finally, for a sec. When we think about this market, I tried to think, what do I say in 2 or 3 minutes about this cattle market, okay? So what I'm showing you is the nearby feeder cattle futures contract, okay? The reason this is the best indicator I've got of the overall market. If the feeder cattle market had a pulse, this is the pulse, okay? And I think if you look at this chart, you can see the message is pretty clear, and that message is, wow, okay? We spent the first 10 years of the last 20 trading in this range of $50 to $100 per hundredweight, okay? We spent 6 or 7 more hovering around 100 or so per hundredweight, okay? Notice, though, the last few years, okay, we've more than doubled prices from where they were 4 or 5 years ago, okay? This is an extremely strong market. Several reasons for that. Tight supplies are certainly a major factor. That's the one most people talk about. This cow herd right now is about the same size as the cow herd that we had in the early 1950s, okay? So beef production is down, cow numbers are down, that's part of it. To that, I would add strong demand, okay? Ask anybody about retail beef prices, and they'll tell you they're really high, okay? That's a function of strong demand across all the meats, and understand that the main 3 meats in American diets, okay, chicken, beef, and pork, they benefit from the fact that each other are high, right? They're substitutes, okay? So meat prices are high across the board. That's benefited all markets, certainly beef. The third thing, something my colleague Dr. Davis will talk about, we've cheapened up corn quite a bit the last few years, okay? And nothing drives a feeder cattle market like cheaper corn. And those 3 things together have taken us where we are in terms of feeder cattle prices right now. As we start thinking about the future, one big question is, are we going to start seeing some growth in cow numbers? Okay, and I think the answer is most likely yes, with one caveat. What's always the caveat? Weather permitting, okay? That's always the question. In terms of 2014, though, I think the weather largely did permit. We had drought in some areas, certainly, okay? But if you look at the last really 4 or 5 years, this is probably the best weather year across the country that we had in terms of beef cattle production, okay? It's certainly dry in the far west. It's still dry in the southern plains, but not as bad as it has been otherwise. Northern plains and southeast, though, pretty decent weather. One more point I want to make. When we talk about expansion, we talk a whole lot about heifer development, okay? And that's very, very important. Long term, the way we grow a cow herd is we hold back replacement females, okay? What I also want you to know, though, is that we've had so much drought in so many key areas, in particular the southern plains, the last 3 or 4 years. We've had to cull this cow herd extremely hard. Okay, we tend to cull older cows, we tend to cull poor producers. What I want you to know is that most likely this cow herd was a whole lot younger coming into 2014 than it was 2 or 3 years ago. Okay? And if you go back and look, really start in the second half of 2013, we have not culled near as hard. We've not slaughtered near as many cows as we were before. Okay? So my actual take on this is that we're very likely to see beef cow numbers a bit higher in 2015, not so much because of heifer development, but more because we're just simply not culling as deep. That difference in cow slaughter, I think about half of it is the fact that the cow herd is smaller. I think the other half is the fact that we have a younger cow herd that's just simply not getting culled as hard. So in terms of 2015, here's what I look for. Slightly larger 2015 calf crop. I think expansion is ongoing right now in some parts of the country. I think weather permitting, it continues in 2015. My projection for price for next year, I look for a very impressive spring calf market record. Okay, I think this was a nice fall calf market. Wait till spring, we put some grass on this market. I think it's going to be a very strong spring calf market. In terms of fall, I look for us to be a little bit off our levels from this year, but easily the second highest fall calf market on record. Okay, last point I'll make, a lot of people have said to me, Kenny, as high as calf prices are, how can anybody afford to background cattle, or stocker cattle for that matter, okay, in a market like that? But you know, the honest truth, if you look at the numbers, the margins being offered, what calves are running for, what deferred feeder cattle futures are selling for, the margins have not changed that much. Okay, the margins haven't changed that much. Feed's actually a bit cheaper right now than it was 2 or 3 years ago. Okay, I think there's potential there. What I also think there is risk, and I always tell folks who background cattle or stocker cattle, manage that price risk. Okay, we're in a volatile market, a lot of uncertainty. Manage downside price risk. That's your biggest risk doing this.
Good morning, everybody. This is my first time providing this outlook. Kenny was trying to get some of the good feelings for the cattle prices. I wanted to inform everyone I accepted my offer around May 20th, which actually coincides with the slides in the December corn, November future prices. I'm pretty sure it's just coincidental, but I'll just apologize up front in case if that had anything to do with it. Anyway, you are harvesting or have harvested a record crop. You probably have seen it on your yield monitors. We're looking at the 2014 crop with a record yield of 173.4. That follows a trendline yield of last year, but you notice we came through 4 or 5 years of below trend yields with a significantly low yield in 2012. So as far as what the market needed, it really needed a home run like the 2014 crop to rebuild inventories. We planted and harvested about 4.5 million fewer acres this year than 2013, and that's just based on relative profitability of soybeans versus corn this past year. We're looking at, for projections for next year, further reduction in corn acres, again based on relative profitability. Some analysts are suggesting 2 million fewer acres. More aggressive analysts are thinking maybe 4 million acres less. And that's really going to see this change up in the fringe areas. I would expect the Dakotas to reduce corn acres into maybe soybeans or small grains. In areas where when you have a 5 or 6 in front of corn price, it makes corn attractive. You put a 3 or 4 in it, you can probably find a better use for the ground. And I'm projecting next year with normal weather a trend line yield of 165. Supply and use has been very strong for corn. We're looking at a total supply of this market year, a record 15.7 billion bushels. So you take a record crop of 14.4 billion, you have a carry-in and some imports. We have 886 more million bushels of corn to market this year than the previous marketing year. Use isn't going to keep pace with that. We're going to see increase in feed use, and we're going to see a slight increase in industrial use. But exports are going to be off a little bit, just based on competition from South America. So we're looking to increase total use of corn by about 114 million bushels this marketing year over the last year. That's going to push stocks for corn over 2 billion bushels, which is the largest amount of stocks we've seen since 04-05. For 2015, if we have fewer acres, trendline yields, we're going to draw down stocks potentially to 1.7 billion bushels. This is the stocks used in marking the average price. We came through several years of very tight stocks, with stocks used being below 10%. The two back-to-back good crops have allowed the inventories to build up, which isn't supporting those record prices that we enjoyed in the 07, 8, 9, 10. So we're looking at maybe 350 corn for this marketing year. If we drop stocks down next year, that would support slightly higher prices in the $3.80 to $4 range. For soybeans, again, you produced a record crop, potentially 4 billion bushels of beans produced this year, and that's based on a record amount of soybean acres. Planted 7 million more in 2013 than in 2014 than 2013. Coupled with that was a record yield of 47.5 bushels an acre. Next year we're looking at increasing acres. I think in the Midwest, farmers are going to look at soybeans being more profitable relative to corn. So we're looking at maybe 86 million acres of beans planted next year and a trend yield of 44 bushels an acre. Use for soybeans have been very strong. We have crushing demand that's going to be up marginally from last year, and very strong exports. Most of those beans are going to China. So we're expecting to see use to increase by about 140 million bushels over the previous year. But we've had such a record crop, we're going to increase stocks to about 450 million bushels this year, with potential to bloom to 500 million bushels next year. Well, the next slide that should be there is the price forecast. So as you increase your stocks, you're going to not support those record prices. So you're looking at $10 beans this year, and in the neighborhood of $9.10 to $9.30 next year. Wheat. Well, wheat's a crop that's been plagued with that lingering drought in the southern plains in Texas, Oklahoma. We've seen slight increase in acreage year after year, but the low wheat yield in 2014 reduced the size of the crop from last year. Forecast is keeping planted acres about the same, but if we get normal weather, we can actually harvest more acres and increase yields. And so the trend line yield for wheat would be 45 bushels an acre, which would be up from the 44 that we harvested this year. Supply and use. Use for wheat has been pretty stagnant, and mostly because of the strong competition in the export market. You face competition from Australia, Canada, the former Soviet Union. So we're looking at fewer exports this year, but there's always potential that some of the key production areas around the world could have a production problem and we pick up some business. But we're looking to increase stocks this year to over 600 million bushels, and next year potentially 700 million. So we're not going to be able to support the higher prices, and the fundamental support in wheat that benefited from high corn isn't there. So we're looking at wheat prices this year at $5.90, with potential prices next year $5.35 to $5.45. So concluding comments, low prices was going to be a profitability crunch for all of the grains, and as Will suggested, the biggest cost component is rents and land values, and that's a sticky cost. It's going to take a long time to come down. So expect to have profitability issues this year and next. Your safety net is crop insurance. That guarantee is reset every year. We've enjoyed very good price guarantees, but it's not likely to be the same amount of guarantee next year, so prepare for that. And currently, farmers are doing their farm bill decisions, and UK and FSA will be holding some meetings to help you with making those decisions. Thank you.
Well, the tobacco outlook, I guess, to generalize it is, Tommy, it's complex and always has its share of challenges. One slide I think is very interesting. You know, think about this post-buyout era, and I don't know how long, Rod, we can continue to talk about the post-buyout era, but one of the things that's always surprised me, I expected a lot of volatility in the post-buyout era, but look at this graph here in terms of acreage, burley acreage. Really surprising in how flat that has been. I mean, we really haven't adjusted much in terms of acreage. Now, some of it's been market driven, but a lot of it's due to the fact of access to labor and barns and equipment has enabled that to be relatively flat. But as we look forward, I do have some concerns that story is going to change. Typically, the past 4 or 5 years, we've been more so in the seller's market. We've had all these people to get out of the industry. We've had somewhat stable demand, some low points in world production, and as a result, whether you were a contract grower or non-contract grower, whether you had a good tobacco or bad tobacco, you did fairly well. But again, I think we all realize as we look at this marketing season this year that things are beginning to change in the tobacco sector. And a lot of it's been driven by this slide right here. In terms of, if you look at these last 3 years, the world burley output is up by more than 35%. Big increase in production. And as a result, you take a situation where you have an increase in supply of that amount, plus the fact that demand on the export market is declining. We've seen leaf exports off about 25% this year. Cigarette sales here in the U.S. are off about 5%. Outputs, cigarettes production's down about 7%. And Rod, you pointed out in the tobacco section that if you look worldwide in terms of consumption, that most of our markets are off about 5 to 7%. So again, big increase in supply, pull back on the demand, and as a result, we've got an excess supply situation. The latest crop forecast USDA put out a month or so ago for U.S. barley was around 212 million pounds, more acres, higher yield. But I don't think there's a buying entity out there that really expects our crop to be that large. And probably it's a good thing, unless you're one of those that not going to have the pounds you anticipate. It's a case where we had maybe a few more acres out there, but I think the overall yield will probably come down. We have a situation where some of the tobacco may not actually made it to the barn. So again, I don't know how far that number will come down. Gary, I think it'll probably be below 200 million pounds, but as I look at the demand of use out there, those bars, and you can see again the fairly flat amount of use in recent years, I think 2014, 2015 really needed a crop of about 170 to 180 million pounds. So there may be 10 to 20 million pounds available out there, even when you pull back this USDA production number more than we actually needed in the marketplace. So obviously a situation where production is greater than use. I don't have to tell you the companies are probably being more critical in the grading. Certainly we've got some Halsburn tobacco, we've got some tobacco with some green in it, and the companies are being pickier, lower quality. We've got some muddy tobacco that's going to hit the marketplace. Obviously this non-contract tobacco is very, very vulnerable. And as a result, we're going to see probably prices that reached record levels last year are going to be coming down a little bit. Now, with saying that, I know I've talked to several of you all so far. Receiving station prices for good quality tobacco is still doing very well. We're still seeing tobacco up there, $1.90s, $2 a pound. And, Greg, I think, good quality tobacco will continue to sell very well. But again, some of that tobacco that was not contracted, especially lower quality tobacco, is going to struggle. I think Probably, Bruce, one of the quotes you had recently from one of our county agents said that the best indicator of how strong the tobacco market is how many bales are going back home. And I think we will see some of those bales will maybe continue to go back home. And the question is, Arnold, what's going to happen with that excess tobacco out there? So, again, more concerned on the Burley side. We'll probably see some reduction in overall contract volume in 2015 due to this excess global supplies. I don't think it'll be across the board. Some of you all may maintain a certain base with your buying company out there, but I do think that in aggregate, Clint, that pounds will be pulled back. Dark tobacco, we've been talking about the story for years and years and years, being driven by the snuff market growing 5, 6, 7% a year. A little bit alarmed early on the first half of this year. Snuff sales were down about 3%. Talked with some of the company personnel, and I think overall sales may be flat to maybe a little bit of an increase when the final numbers for 2014 come about. But again, the market seems to be somewhat flattening off compared to the growth that we've seen in over the past couple of decades. Acreage was relatively flat. USDA has production of dark fire and dark air about 65 million pounds, probably a little bit optimistic. We may see that pull back a little bit. But overall, I think the supply and demand balance for dark tobacco is a lot better compared to where we are with Burley. And as a result, the market prices have been very, very strong. Dark fire typically $265, $270 a pound. Dark air in the $235, $240 a pound range. So, you know, there's no doubt that we've had some volatility in Burley out there, but the continued strong dark tobacco market has enabled the value of tobacco production here in Kentucky to not only sustain itself in the post-bio era, but Mr. Lawson, we've actually seen some growth over time. I do think with the lower overall prices we'll see for Burley, and I don't think we'll have a dramatic pull down in the overall average. Certainly we've got a lot of volatility there, but we'll pull back a little bit on Burley prices, but we've got more pounds out there probably to sell this year. And given the strong value in the dark tobacco sector, we're going to pull that value back a little bit in 2014, but still be roughly around $400 million. As we look ahead to next year, not surprising that given the ample world supplies, given the increasing value of the U.S. dollar, and given some accelerations in U.S. cigarette consumption, again, I anticipate that we'll have lower Burley contract volume for 2015. Again, I feel very good about the supply and demand balance for dark. Probably not a whole lot of change there. But overall, when you combine the two, I think we'll still be challenged to maintain that $400 million level that we've had in the past 2 or 3 years. Some of the issues to watch, a lot of discussion about regulations, probably what FDA will do and how long it'll take to make some adjustments and how the companies will respond to those adjustments that affect you as growers. Also a lot of discussion about some international tobacco regulations, how that would affect the growing sector. Been much discussion about trade agreements. We're in a couple of major trade agreement discussions, which agriculture is very interested in. Been a lot of discussion about whether or not tobacco will be part of that or be carved out of those agreements. Immigration reform remains a hot topic inside and outside of agriculture. And given our dependence on H-2A labor, Rod, we had a lot of discussion around tobacco session this morning about immigration. And then finally, the hot button issue in the tobacco industry these days is the modified risk or harm reduction products, these e-cigarettes and vaping markets. It's a market that's only about 2% of the total market, but it's a market where some analysts feel that within a decade it could escalate to be as much, if not more, than the traditional cigarette market out there. So the question becomes, will the U.S. grower be a part of that? Will there be taxation and regulation on the industry? And again, how that will impact the grower as we move forward. But again, at this point right now, very little, if any, of the tobacco and the nicotine that are in those products is derived from U.S. tobacco. But that's the growth market potentially out there for the tobacco sector in the future. So with that, we'll move on to our next outlook. Some of us are very lucky to only have 1 or 2 commodities to focus on, and Tim has got 100 things to talk about in 8 minutes or less. So Tim, take over on horticulture.
Thank you, Will. Yes, good morning, everybody. So with horticulture, it certainly is a diverse set of crops, a diverse set of markets. lots and lots of things that are going on, and it actually does help that we have a lot of emphasis and diversification as we look at some of the different risks and issues. The kind of the big picture that I want to sort of start with is to just show what we've seen is, particularly in the last couple of years, generally a very positive development with respect to the sales for our horticultural crops. The nursery industry, after kind of a rough patch of it there, finally starting to see a little bit of a rebound. But both for our produce, for our fruits and vegetables, a lot of it driven through our auction sales, a lot of it driven through very strong demand for local products to local markets that we'll talk about here shortly, have certainly helped. And so we're going to see this year probably the highest level of overall cash receipts that we've ever seen for our Kentucky horticulture sector when you patch it all together. This just sort of looks at the numbers and just sort of the steady growth that we've seen over the last 15 years. And it's been interesting, Sam being part of the Ag Development Board initiatives there, trying to help encourage a lot of the diversification and development of the horticulture sector. Some fits and starts, but some slow, steady progress, I think, that we've seen over time across all those horticulture sectors. The big drivers behind some of this growth, of course, is the direct markets. As we have interaction with our producers, they still point to over half of their sales are coming to local markets. But the other thing that we've seen in Kentucky that's been a big driver on the produce side has been the growth in the number and the volume of sales that are going through our produce auctions in the state. In addition to that, though, we're seeing more, there are lots of market channels that are involved here. We're seeing grocery, restaurant folks that are also sourcing more product as well, and wholesale partners that are being involved in that. This just gives you a little picture, again, nationally, of the interest into local foods to local markets, the growth in farmers markets in general, that continues to expand at quite a striking rate. We actually are extremely fortunate here in the state of Kentucky to have a really strong state branding program with our Kentucky Department of Ag and Kentucky Proud program. A lot of really innovative programs and impactful programs have been put in place to help a lot of our food-based businesses that are processing products, but also the marketing of fresh products as well. One of my favorite programs out there is the Restaurant Rewards Program, where the restaurants that are sourcing Kentucky Proud products can actually get a rebate for up to 20% of the purchase of those local products. And you can see the growth in the number of restaurants and institutions that have been participating in that program, and it has really helped raise the visibility of a lot of our Kentucky products in these different retail markets. The Farm to School program also really taking off. We're seeing just a lot of interest in these local products in our school cafeterias, including Dean here at the University of Kentucky with a lot of the new initiatives that we're seeing with sourcing local products into some of our local institutions that are themselves big buyers. Just a couple of quick words about, I'm not going to have time to go into every sector of every commodity within horticulture, but I did want to say a few things. I continue to try to point out you can see the growth in the number of wineries across the region, and certainly in Kentucky there as well. A lot of that being driven by interest in the agritourism. Our wine products, we like to hope that they're getting better over time, that they're improving, that there's some learning and experience benefits that are happening there. Getting some good feedback from consumers there that are trying some of these wines, but not without some challenges. And obviously the liquor laws in Kentucky are like no other place on the planet in terms of just the complexity of it. But we continue to see some growth in the number of wineries, the number of acres of grapes that are being produced, and the amount of wine that's being bottled in the state in general. Let me just close with a couple of comments and observations about the nursery sector. And a lot of times when I've come up here in recent years, it's been with this kind of gloom and doom outlook. The nursery sector had received a really big setback in Kentucky from where it had been growing earlier. But you can see this kind of national trend here in terms of overall total sales. And you see when the recession hit back there in 2007, 2008, the huge hit that impacted the nursery industry nationally. And it's kind of plateaued. They're stabilized there finally somewhat, but still trying to find its way back to those higher levels. But if you look at just, this is drawn from the Census of Agriculture data, some of the best data I think that we've got to look at Kentucky compared to some of our other regions. You can see from the 2007 where it had peaked there to kind of our current levels there, the big hit, particularly look up in Illinois, the big drawback there. The good news, I guess, for what it's worth, is Kentucky has not pulled back as much as some of these other states in terms of the gross sales there. And I get this question a lot: is there market room? Is there room for growth in produce and in the nursery sector there? And you can see, compared to some of our other neighbor states, we're still a pretty small share compared to some of those other regions there. And a lot of our nursery products are being distributed and marketed throughout this whole region there. So there's certainly room in the market for Kentucky to be a bigger player than they are, both for nursery sales and for produce. So to sum it together, the interest in the local products, whether it's the retail grocers that are stepping up, the restaurants, the farmers markets, on-farm retailing programs, the Farm Bureau's Certified Roadside Market Program, all these kinds of opportunities are creating some really positive market demand for our producers, and so that's going to continue, I think, to drive growth looking forward. We're going to see continued local institutional demand, whether it's universities, hospitals, other agencies as well. The auctions continue to just be very striking opportunities for growth for our producers, and have contributed a lot to creating opportunities for our fruit and vegetable producers, and for our nursery and floriculture folks as well. I'm really pretty bullish about the continued growth and the rate of growth that we're going to see for our horticulture sector even on into next year. A lot of that driven by demand, but also by the institutional support that we've seen from the Department of Ag, the marketing structures, and the other buyers that are coming on board with these local products. So with that, I'll turn it over to my esteemed colleague, Mr. Pierce.
Thank you, Tim. Let's take our projections and try to apply them to actual Kentucky farms so that we can look at three things: farm profitability in 2014, management in face of lower profitability, and a related issue would be family living. We'll be taking our numbers, our data from the Kentucky Farm Business Management Program. We're looking at 540 farmers on 360 farms. We're going to focus on one segment, and that's the 222 grain farms in our average. So that we'll be using the average numbers for the grain farms in the program. Last year, 2013, that average farm included 2,400 acres and a $2.3 million gross income. What was net farm income? What was profitability on that $2.3 million of gross? $544,511,000. That's part of a long-term trend that we've seen since 2002. Now, you'll notice that I've switched to net farm income from net cash income. Net cash income would include last year's crop sold this year, and it would include a lot of expenses that are going to go out the door here this month in prepaying for next year's production. When we look at net farm income, we're combining the value of the crop produced this year with the cost of the crop this year and the production this year. So what you're seeing, we've eliminated the influence of income tax and value fluctuation in markets and the influence of salesmen, and looking at what was the actual profitability for the production in each year. Now, USDA projection, Will's already talked about it, net farm income for this year is going to be down 21% for all U.S. farms. Now, our grain farms are not like all U.S. farms, So we're going to go into the numbers and look at the line by line, item by item changes in expense and income over last year. For instance, chemical expense is projected to be up 1.9% from last year. So we'll take last year's grain farm expense and increase it by 1.9%. We'll increase fuel by 4.2%. We'll look at increasing our last year's labor cost on these grain farms 7%, and repairs by nearly 6%. We'll also look at the income side. It's been mentioned already, a 12% decrease in crop sales and in government payments, but significantly an increase in inventories. That's what we're holding on to at the end of the year. It's supposed to, well, USDA projects 30.5% increase over the year ago. Putting those projections line by line, item by item, on last year's income and expense, the average grain farm would be projected to have a net farm income this year of $402,000. That's a 26% decline in net farm income. What are farmers doing about that? How are they managing in face of declining markets? Well, first off, they're not going to learn about that at this press conference. They've been living it for some time. One of the things I've already mentioned, and I'll mention three things here that management's doing. One is that ending inventory. A lot of that ending inventory value, 30.5% increase over the year before, is driven by better production. We've already seen the slides up here. But those managers, those farmers are going to use that inventory. They're going to take advantage of pricing opportunities throughout the year. That's number one. Number two is, and three, they've already done this. They've been looking forward to this for some time. And in the last 4 or 5 years of profitability, they've increased or improved their financial condition. When you look at total assets involved in the farm, we were at $5 million total assets at the beginning of 2010. At the beginning of this year, that average grain farm consisted of $8 million in total assets. They added equipment, they upgraded equipment, and in many cases they added land. During that time, the red portion of each bar, it represents the debt. During that time, they've increased their debt. They've actually managed to maintain a debt to asset ratio of about 27 or 28% year to year. So they've increased the size of their farm without increasing the relative debt to asset ratio. They're in a good long-term solvency position to weather any kind of problems. The second thing they've done financially is they've put themselves in a position where they can take advantage of opportunities and meet challenges as they come. So we're looking at working capital as that measure. That's the amount of capital, that'd be cash and crop on hand and prepaid expenses, above and beyond what they've obligated to pay in principal payments this year. Beginning of 2010, that was $600,000 of unobligated working capital. At the beginning of this year, they had built up to $1 million, the average grain farm, to $1 million of unobligated working capital. These two things have put us in a good, this has put us in a good short-term liquidity position. Now, the other question that we asked was, what about family living? Well, 2013, the average grain farm, the average farm that we work with, spent about $51,000 in general expenses, Walmart, groceries, clothing, etc., and about $33,600 in income taxes. Now, that whole pie represents $105,860. That piece of pie, that big pie, that whole thing is comparable to your paycheck and mine. Not necessarily in dollar amount, but in what it comprises, what it's made up of. And we're comparing here self-employed people to folks like me. I take a paycheck home. I'll get that. How does that compare, the 2013 family living expense, to previous years and historically? Well, we've removed the taxes here so that we're looking only at what families spent. $77,708 was our peak in 2009. It dipped down, and in last year, 2013, it had come back up to $72,000. We're projecting a 17% increase in family living to $74,000 this year. Three things we looked at. Family living, we think, is moderate. Profitability is certainly going to be down 26% on a average grain farm this year, but farmers have been managing the good times in anticipation of the not so good times and put themselves in a good financial position. Jeffrey Stringer is coming up to talk about his forestry report and outlook.
Thank you. So we'll spend a few minutes looking at the total contribution of the forestry sector to the economics here in Kentucky and look at some of the key timber commodities as well. I'd like to thank the team that's worked on this and also thank contributors from the Kentucky Division of Forestry whose data we would not be able to live without. Same way with the U.S. Forest Service and Kentucky Forest Industries Association, so we appreciate them. So we'll have a quick look at total economic impact, estimated to be in 2014 at $8.3 billion, with a total contribution of $12.8 billion. And there's our direct employment and total employment numbers as well, and that's up 5% over estimates for last year. And unlike my other colleagues, I will take credit for all of that. So these are the sectors that are involved in that. You see logging circled over there, so we start there. Primary milling, that's sawmilling. Pulp and paper, we have 2 pulp and paper companies and facilities here in Kentucky. Secondary industries are making our cabinets, our flooring, barrels, those kind of things, and then paper converters. Paper converters making regular copier paper, those the kind of things, Dixie cups. And we got to thank the paper converters, because if you went through fast food, they just dumped the food in your hands if you didn't have paper converters. So they're big. Everybody is up substantially. We've got responding to the uptrend in the U.S. economy. All sectors are up. Logging, there's a lot of volatility in that right now. Estimates are very hard to do. It's the sector here that I'm worried most about for a couple different reasons. One is it's tough. It is very fragile. And if you pull that sector out, about 2/3 of the rest of this collapse. So that's a small sector there that we really got to keep our eyes on. We did maintain stability in the number of industry locations, 703 facilities in 109 counties. It's the same as last year. We've had an increase in 576 loggers since 2012. And we have good logging distribution, those that cut and haul our material out of our farms and woodlands. Overall production estimated in 2014, we're up. We're still climbing. You can see what the recession did to us in overall production of saw logs. We're still the leading producer of saw logs in the South, in the top 3 in the U.S. So we contribute significantly overall to the national situation in regards to hardwood lumber production. And those numbers are up, we estimate, about close to 4.5% over last year, and that is a sustainable level. Oftentimes we get that question as well. Can we sustain the level of cut that we're at now? And we can't. This is kind of a noisy graph, and I'll try to simplify it. This is the delivered log price per 1,000 board foot of grade 1. That's high quality logs. The logs are going to be cut into good grade lumber that you use for a lot of different things, high quality cabinetry, furniture, all that kind of thing. Each one of those lines represents a different species. Black walnut's at the top, followed by white oak, and then the red line is red oak, and underneath that, and the very bottom is yellow poplar. And so the main point here is you can see what's happened in the last year. All those different graphs there are going up, and lines are headed up for all species, and I'll show you specific data on that. But one reason that I put this up here is because let's look at red oak right here, which is one of our more important species group in the state. And you see the levels of the red oak pricing that was out in here, 2000 to 05 and going into 06. And you can see the levels that shrunk to over this fairly substantial amount of time. And you look at the levels they're at back now. All these species are going back to pre-recession levels, and that's fairly significant. That's money in everybody's pocket. And so what the graph that we just saw was this column right here for high-grade logs. Here's a different species, of course, and you see we had a 23% increase in all those species. Grade 2 are medium-grade logs, and grade 3 are low-grade logs. So what you see here is that we've had a percentage increase across the board, all species, all quality of logs. That's a good thing. Hickory was one of the more important species this year. Sometimes it can be a very, very low-valued species. We have hickories in almost all woodlands. It's commanded good price increases this year for all grades, and particularly low-grade materials. So that's been a mover and has contributed to improved cash receipts. and profitability overall. And I'll finish with just looking at a couple commodities here. Tie logs. So these are logs that are used for the production of railroad ties. Very important here for Kentucky. We export them, and it's been a staple. The development and the cutting and hauling of tie logs has been a staple for our industry for a while. Every acre of woodlands has tie logs in it. That's very important. We've seen a slight softening in the price of those this year. There are reasons for that. It will rebound, or it's a predicted rebound next year slightly. And those numbers, even though softened slightly, are still good numbers and it's still quite profitable. Okay. Stave logs, a lot of talk about bourbon and the importance of bourbon worldwide and increased sales of that, and whiskey as well. And wood is a big contributor to that. You can't have bourbon without it. And there's been an increase in demand for barrels, staves, stave logs that go into production of cooperage and barrels. And we've seen an increase in price of that, and that is going to continue. The estimates on bourbon consumption, I don't know who's drinking them, keep doing it because it means more barrels. That's good for the wood industry. And so there is concern over sustainable supplies, though. Those are all made out of white oak, and so we have a lot of pressure on a particular species. So that's something we're watching. Exports were a big thing. They've been coming up since the recession. You can see what happened with Asia right there. It jumped up significantly this last year. And so our exports are up overall. Asia being one of the primary movers, of course. Our biggest wood export is used wooden barrels, cask. And that includes both going to the EU and Europe, as well as now Asia. And of course, the overall trend in the wood industry and the health of our wood industry is related to overall U.S. economy, and housing starts as an indicator of that, and because in housing you use flooring and cabinetry and furniture and all those kind of things and products that we make here and supply saw logs for and lumber for. And so as you see the increasing in housing starts generally trending upwards, that bodes well for forestry. It bodes well for components of horticulture as well. And so I'll finish this up by saying, looking at our 2015 outlook, saw logs for lumber, the demand should peak in 2015, and there should be still a strong presence of the South and a market share. So we're going to maintain good market share predicted to here in the South. Low-grade logs, those are for cross ties and pallets and those kind of things, stable to slightly improving markets in 2015. And the ties are set to rebound and stabilize in 2016. So we're looking at a good year, should look at a good year next year as well. Pulp wood, that's a production of paper, is going to be stable. We have two facilities here in Kentucky, a NewPage facility and a Domtar facility, and that NewPage facility is going to be bought out by Verso. So what happens there and that acquisition is going to play a part, although all indicators in the industry, they've shed some, Verso's already shed, and NewPage have already shed some facilities, not the one in Kentucky. So it looks like we're going to be stable there and maintain that economic output from them. And as I mentioned before, stave logs, the demand is going to exceed the supply, so that's a good thing from a seller's standpoint. So overall, in timber as a commodity, it's a seller's market, which is good for woodland owners and farmers.
Thank you, Jeff. I left this as an optional section, time permitting, and it does. So let me provide this one slide trailer for Allison Davis's report that's going to be released by the end of the month. The numbers are all in, which I'm showing some of them here, and the writing of the report is in the final stages. Allison Davis is the Executive Director of the Community Economic Development Initiative of Kentucky. So the purpose of this study was to estimate the total effects of the ag and food cluster on Kentucky's economy, and that can be used for a number of purposes. The ag and food cluster includes everything from ag inputs through ag production itself, and then it includes the food and fiber products that are processed from ag commodities. So ag processing, that includes everything from slaughter facilities to snack food manufacturing to distilleries. What it does not include, and this is important, is retail, grocery, or restaurant sales. There are three kinds of effects that are included in these numbers you see here. There are direct effects, indirect effects, and induced effects. I'll give you an example of each. We have a relatively new grain elevator in Meade County. So that added jobs and that added sales to the economy, and that's an example of a direct effect. So suppose there's a river transport company that now has added business because of the new grain elevator. It adds jobs and adds sales to the economy. That's an indirect effect. And then the employees of that grain elevator and the river transport company go out and spend the extra income they have now at local stores, and that's an induced effect. So when you sum up all of those results, that is what combines to give you that $43 billion figure for the total importance of the ag and food cluster to Kentucky's economy, and the 267,000 jobs that it contributes. Another way to think about that is that that's about 8.4% of the total Kentucky economy. And as you can see, about 3/4 of the impact comes from processing. About 1/4 of that impact comes from the ag production itself. So again, that's just a drive-by shooting of a report that's going to be coming out very soon. Allison Davis and her staff at SEDEC are in charge of that. And we've had a lot of information from our speakers here today. And at this point, if the members of the press would like to go first and ask any questions, go ahead and fire away. Yes.
Jeff's question is about Philip Morris's new purchasing pattern. Philip Morris International has decided, instead of purchasing tobacco directly from growers, that they would implement the dealer system, which we've had for decades. Their reasoning behind that is to improve cost efficiencies, the use of the dealer system. And I think the jury's still out in terms of the impact. I hope that it would mean that we would see some of the benefits not only to the company from a reduced cost standpoint, but also some benefits to the growers in terms of hopefully sustaining some of the poundage out there that is being jeopardized right now by the declining demand for overall tobacco. Big question out there, will other companies follow that same model? Kind of reminded me of the story about boarding an airplane. You know, we have the Southwest model, and then we have the other carriers at different viewpoints. So I don't know which model is better than others, but there's definitely going to be a change. There may be some reduction in receiving stations. I don't know if they've been announced yet in terms of how many receiving stations they will have. But I do think on the positive side, it does keep those tobacco processors who've made a lot of investments in some of their processing plants more fully utilizing their facilities. So again, there's been a lot of shifting of tobacco processing overseas, but at least including those two dealers as part of the buying for Philip Morris International, at least hopefully it'll keep more pounds being not only processed here in the United States, but also produced. So just some observations and early on, and we'll see what transpires.